PayPal stock, you look at this stock and you say, it's got to be a trick. It's too good to be true. It seems like too easy of money to be made in the stock over the next couple of years. Like there's got to be a trick here. And a lot of people are asking themselves this, right? And I understand because Wall Street's treating PayPal stock recently like it's a buy. They'll buy the stock. They buy it at 59 bucks or so, right? They buy it in the high 50s, maybe just above 60. It goes up to $65, $67 a share, and then it goes right back down. And this has been what PayPal stock has been this entire year. They buy it, and then they say bye to it, right? And it creates this kind of disillusioned feeling in regards to PayPal of like feeling like, oh, here we go. We're starting to make our move. Here comes 70, here comes 80. And it never comes, and it goes right back down to the high 50s, and then it gets bought up again to 65, 67, and then gets sold right back off. And it's a very disillusioned feeling for a lot of folks. And it also leads in this kind of belief of like, maybe this is a trick, maybe it's a trap. It's just got to be, it can't be a situation where this actually works out, right? And this is all while you see in the most talked about stock in the market go up 3+% almost every single day. NVIDIA, we're not even halfway through the year. NVIDIA is sitting on 175% gain. So people have to listen to the most talked about stock in the market all the time. It's doing tremendous. And then you might own something like a PayPal and you're like, what the heck, man? The stock, what do we have to show for it? A 3% down for this year, right? So in this video here today, I want to go ahead and go through PayPal. But what we're going to start with, we're going to start with the objections. We're going to start with the bear case first for this video. I don't want to, usually I'll start and I'll talk about the bear case first and then I'll kind of destroy like bearish points as the video goes along. Today I want to do this differently. I want to start right with the bear case. And then once we go through the bear case, then we'll get into the bull case in this one. I thought this could be a great way of laying out this video here today, okay? Hope you guys enjoy this beast of a video here today. Appreciate y'all joining me. All I ask in return, smash a like for this video, smash that thumbs up button, and also, are you subscribed to the channel? If you're not, you might want to get subscribed. Alrighty, folks, here we go. So, let's get rolling with the bear case. Competition. Let's get it out of the way right off the bat. That is by far and away the bear case in regards to PayPal stock. People worry about the competition time and time again, right? Competition. Who are the competition? Well, it could be any service that is a fintech related app could be seen as competition for PayPal overall. But I would really say the two main competitors of PayPal, you can remember PayPal they have the PayPal business, then they have Venmo, and then they additionally have Braintree, and we'll talk about Braintree in this video a little later on, okay? But in regards to competition, there's two main services that people think about. They think about Apple Pay, and they think about Cash App. Both of those products compete very differently. Apple Pay is obviously, that's really something that's exclusive to folks that use iPhone. Like that's who's really using Apple Pay at the end of the day. It's folks that are really super into the ecosystem and like to use Apple Pay overall. And if you have an Apple product, specifically an iPhone, you know how many times they bother you about using Apple Pay. It's consistent. It's right from the time you set up your phone to throughout the life cycle of having an iPhone. Apple pesters you about using Apple Pay. And set up your credit card, set up your debit card, and they try their hardest to get you integrated to use Apple Pay. Now, the real reason Apple wants you to use Apple Pay isn't so much to compete against Venmo and PayPal and to make a bunch of money off of that. It's really just to keep you more in the ecosystem. The same reason why they want you to have Apple Music, the same reason why they love you to take photos and videos. Because if they feel like if you are using your iPhone consistently for all your memories, right, which is like photos and videos, you're using it consistently as a processing transaction, right, through Apple Pay, and you're using it for your music, they feel like you're more likely to stay in the ecosystem and not view your phone as a commodity that could be switched from this company and that company. It keeps you in the ecosystem. So that's really why Apple wants you to set up that Apple Pay, and they consistently pester you about it all the time, right? Now, if we look at the top finance apps on the iPhone in the United States, for instance, we're going to see Cash App is number one. That's usually pretty consistently, it's the number one most downloaded app on a daily basis. And then number two, should come as no surprise, it is PayPal. And number three is Venmo, right? Now, right off the bat, I like that, PayPal has two products in the top 3. Now keep in mind, Apple Pay, you're not going to see that listed here, which might seem like, oh, maybe Apple Pay is not irrelevant. No, it's just Apple Pay is pre-installed on iPhones, so it's not going to show up separately as like a finance app here, okay? Then after that, you get Zelle, Capital One, JP Morgan, Chime, other products like that, right? Now, ask yourself, when did Cash App come out, right? Well, Cash App came out in 2013, so over a decade ago. So that is certainly no new product out there. When did Apple Pay come out? Well, Apple Pay came out about a decade ago. It came out in 2014. Google Pay surprisingly launched in 2011, which goes to show you that it's not all about first mover, because otherwise Google Pay would be dominating out there, and it's not. When did Zelle launch? Zelle launched in 2017, right? And Zelle's that service essentially that has most of the big financial institutions signed up for that one, right? So the moral of the story is competition's not new. It's not new. It's been around. And you got to ask yourself, well, how's PayPal done with all this competition? And I think that's a very fair question. Well, here's PayPal's revenue over time. They grow and they grow and they grow and they grow and they grow, right? So despite all of that competition I just went through there, right? Cash App and Apple Pay and all the other products, Zelle and all the other products, right? Despite all that, I mean, PayPal's done just fine for themselves with all that competition. And then in terms of growth rates for PayPal, certainly they've had stronger growth rates than recently. This was during Rona, but keep in mind during Rona, it's kind of an unfair comp because a lot of these sorts of companies' growth rates went insane in the back half of 2020 and into early 2021 during the shutdowns. Shopify is another great example of that. Amazon's e-commerce business, another great example of that, right? PayPal's another great example. So in recent years, the growth hasn't been as strong. And obviously, you also have the consumer getting hit by inflation for 3 years. But with that being said, the growth rates have actually picked up here recently for PayPal overall, which is very good to see as well, right? And also, look at here. You had a major drop-off in growth rates there, too. And then you had another big pickup, then you had another big drop-off. So just something to keep in mind. But at the end of the day, the moral of the story is the growth is higher and higher and higher in terms of revenue for this company. Now, next up here, what about net income? What about the bottom line? Because you might say, okay, competition, they might be able to fend it off in terms of they keep growing their revenue, but maybe they're killing their profitability. Because there's two ways you could really see competition. One's from the top line, one's from the bottom line. So if PayPal's profits, right, their profitability is getting destroyed because of competition, then you have a good bear thesis, right? But it doesn't look like that at all. If we go back and look at the last 4 quarters for this company, the June quarter, $1.02 billion of net income for the company. The September quarter, $1.02 billion of net income for the company. The Christmas quarter, December 2023, $1.4 billion plus of net income for the company. And the most recent quarter, $888 million of net income for the company. And that compares to $795 million of net income for this company in the same quarter last year. So it was up significantly. So clearly, we're not seeing the competition eat their revenue. We're not seeing the competition eat their net income, right? So that's that. Now, Alex Chriss. If you're a bear, you may say, hey, this guy, we don't know about him. He's never been a CEO. He's only been at the company for a year now at this point in time. And so, newer CEO, they're going to say, right? Technically, I don't even know if it's been a full year for Alex Chriss yet, right? So, Alex Chriss, this gentleman comes over from Intuit. He most recently served on Intuit's executive leadership team and the executive vice president and general manager of Intuit's small business and self-employed group, where he led global organization responsible for delivering QuickBooks and MailChimp to millions of customers. Throughout his 20-year tenure at the company, Alex also served as Senior Vice President and Chief Product Officer of Intuit's small business organization, managing the full suite of QuickBooks products, including payroll and payments platform segments. This man is one of the main reasons why Intuit became such a absolutely massive, great dominant company, especially in the small business space. And if you run a small business, I would say there's an extremely high probability you use Intuit. It might be for MailChimp It might be for QuickBooks, it might be for TurboTax, or maybe you use them all because they all integrate very well with one another, right? And this is one of the most key reasons why Intuit ended up becoming such a large, massive organization. And the man's got experience with all of those product suites. So he's really a product, I would call him borderline genius in regards to thinking about how to keep the customers really happy in using those products year in and year out and staying signed up, even though there's a lot of competition. Because let's be honest, you think Intuit's the only tax provider out there? Do you think Intuit is the only company that has some sort of bookkeeping system for small businesses? Do you think they're the only customer that has something like that's an email related service, kind of like a MailChimp? Of course not. Intuit deals with a ton of different competitors for TurboTax, for QuickBooks, for MailChimp. There's a dime a dozen, but yet they've done tremendous, right? Look at Intuit's revenue, why Alex Chriss was at that company. I mean, absolutely extraordinary. I looked. When he was there, they only had one down year out of those 20 years in terms of revenue. And it was right here in 2015, they had their revenue go down 1%. And that's it. So think about that for a moment, right? That's pretty darn impressive. And while he was at the company, the stock price went up 2,000+% while Alex Chriss was there. So remember I showed you his shirt here? His shirt said, "Never been a CEO." That's the bear case. Well, maybe I should say something like this. Never been a CEO, but I have been a boss. Hey, I want to thank you for watching this video here today on the Clips channel. I want to introduce you to 1000xstocks.com. This is the most valuable service you're going to find out there. If you're an investor in the market, this is a tool that's going to help you immensely get to the next level in the market. So when you're looking at 1000xstocks.com, you're able to understand all the different metrics laid out exactly how you need them as a long-term investor in the market. So let's say I wanted to look at a stock like Palantir. I can go ahead and type in Palantir right here, and it's going to say all Palantir's different metrics right here. Let's say I want to go ahead and look at a stock like Tesla. I can go ahead and type in Tesla right here, search, it's going to give me all Tesla's metrics right there. Let's say I want to look at a stock like PayPal. Go ahead, search it up, and then it's going to give me all PayPal's numbers laid out right there. Compare feature is one of the most valuable features of any service literally in the world. And the reason being is you're able to compare 3 different stocks all next to each other in a matter of seconds. It's absolutely, there's no service you're going to be able to find something like this. So let's say I wanted to find out, what do I think is a better buy? Do I think it's Meta? Do I think it's Google? Or do I think it's, let's say, a stock like Microsoft, for instance, right? So I can go ahead, type all those in there, and then hit compare, and boom, in a matter of, what was that, a second or two, it gave me all the metrics out. So now I can say, okay, Meta's forward P is trading at this, Google's forward P is trading at this, Microsoft's trading at this, and I can go ahead and understand this on a very high level. Additionally, we have earnings calls on here as well. So if I need to listen to any companies I own or am researching their conference calls, I can do it right here through the service. So let's say Tesla, if I want to pull up Tesla's latest conference call, boom, I can play it. I can adjust the speed as well. So if I want to listen to it at 2x speed, I can listen to it at 2x speed, 1.5x. I also have the transcripts of the conference calls as well right here. We're also working on a lot of different new features behind the scenes. So if you would like to apply for access of 1000xstocks.com, go to 1000xstocks.com and you'll be able to fill out an application and go from there. Anthony Noto, CEO of the company of SoFi, right? He just loaded up on more shares, bought another 30,715 shares. He paid $6.48 for the stock. Now, I think there's a few things to keep in mind here. Okay, first is there's many reasons why a CEO sells a stock. It could be because they need money to go buy a new mansion. It could be because they need money for taxes. It could be because they want to go buy a big yacht. It could be because they want to diversify their funds around. It could be because they want to give money to a family member. This could be a million different reasons why a CEO goes to sell a stock. But in terms of going to buy a stock, there's only one reason. And it's because you think the stock is very undervalued and you're buying that stock because you think you're going to make a lot of money on it. There's no other reason to ever buy a stock if you're a CEO of a company other than that. That's it. So, the moral of the story is, if Anthony Noto is out there buying shares of the stock and, a couple days ago buys 30,000 plus shares, it's probably because he believes it's going to be worth a whole lot more money than $6.48 in the future. Now, the second thing I want to point out here that might be just as important, if not more important than that, is look at this. If you see the price that Anthony Noto has been buying the stock at, it's very consistently, if we look at really the past couple years, he wants his stock under $7 specifically. So given that there's no one, I believe, in the world that's going to understand this business model as well as Anthony Noto. No one. Okay, me or anybody else, and there's a lot of people that are great in the SoFi community. There's no one that understands this company better. No investor, no analyst, nobody than Anthony Noto. He understands this company on the highest level. So there's something specific about under the $7 level that the risk reward just screams, I have to get more shares of this stock. And all CEOs of their companies have certain valuations and prices in mind that they're like, if this stock goes to this price, I have no choice but to buy it because of just like it's such a ridiculous value. I always remember Steve Wynn at Wynn Resorts. He had certain prices in mind that he just looked at Wynn stock and he's like, this is a screaming deal here. I've got to get more shares. And he would do open buys in the market. Now, he had a crazy amount of money. He was a multi-billionaire. So when he would buy for some ridiculous sums of money. You know, it wouldn't be like $200,000. It'd be like, $200 million or $20 million or some crazy amount. But that was Steve Wynn. So in regards to this, these guys know their businesses better than anybody. They know what the real value is. And so there's something specific here with that under $7 level that he says, this is where I have to buy. So overall, do you look at this as a bullish or bearish catalyst? Certainly bullish, right? Does this mean the stock's going to magically go up tomorrow? No, absolutely not. Anthony Noto has been loading up on shares for 2 years. And look at the stock is still an under $7 stock, right? And the second thing I'll point out before we get into SoFi, the smart money is short, is SoFi is certainly, I think, kind of a laughing stock of this market right now, right? And just keep in mind, things can change. They can change, right? That stock is just, everybody kind of looks at it right now. It hasn't been doing anything. It's under $7, and it just kind of gets cast away, pushed off to the side. But things change very rapidly in the market. And so although that stock's been a laughing stock of the market, really, the past couple of years, don't think automatically it's going to be a laughing stock of the market the next couple of years. Things can change. Remember, Palantir was a laughing stock of the market just 2 years ago, right? No one wanted Palantir stock, it seemed. I wanted it. I was buying it, right? But most people, looked at that as just kind of a joke. And now people can't wait to run over themselves to buy Palantir at $24, $25, $26, right? And, a couple of years ago, people were paying $6, $7 for that. I mean, I have shares in my portfolios at those sorts of prices. So things can change. And so for SoFi, when the interest rate environment is more clear and the economy is a little more clear, SoFi could do very, very well in that situation. The next thing you know, people could be running over themselves to pay $15, $20, $25 a share for that stock. Whereas today, it's $6. So just a little food for thought in regards to that. But let's get onto the bearish side, because I think there's some points we got to talk about here. In a hard landing scenario, SoFi's accounting practices may lead to significant losses, potentially requiring capital raises, making risky investment for professional investors. In fact, the smart money perceives SoFi as the perfect macro hedge for consumer-driven recession. Ooh, okay. Look at this. Why is SoFi a perfect macro hedge? There's little doubt that if the U.S. economy goes into a hard landing coupled with higher unemployment, consumer-focused banks with a large unsecured book are going to experience materially higher delinquencies. Mr. Market is likely to shoot first and then ask questions later. SoFi has almost 70% of its loan book in unsecured personal loans. That is a highly concentrated book, but not the end of the story either. SoFi, compared to peer banks, has disproportionately higher exposure due to what is being perceived as aggressive accounting practices. SoFi employs an unusual accounting practice compared to its banking peers, where it elects held-for-sale accounting designation for its personal loan portfolio. This practically translates to upfronting of profitability from these loans compared to their peers on accounting treatment. Due to one, SoFi recognizes fair market value uplift on day one, typically of 4% to 5% of the loan assets. SoFi also does not provide for future losses as per the CECL methodology employed by most banks. So comparing apples to apples with peers, on day one of originating a personal loan asset, SoFi recognizes a benefit of 11 to 12% of asset value compared to peers, accounting treatment. Since the economic outcome and cash flow are the same, the day one gain reverses over the life of the asset, i.e. loan losses are recognized as they are incurred, and the fair market value bleeds back into the P&L, profit and loss, over time as an expense. I have explained this in more detail in an article. This recent tweet from Collins Porter highlights the concerns some professional investors have when it comes to SoFi accounting treatment. He says, might want to check the records on that. These big institutional investors see awful accounting. When they finally come clean, I'll be a buyer too, he says. So what if a hard landing happens? The fair market value, currently reporting a gain of $607 million, will likely reverse to a large extent or even turn negative. Similarly, the recognition of loan losses will likely be accelerated forward with higher loss severity. In such a scenario, it is implausible that a share price will plummet, right? And so I don't know what they expect the share price to go to, 0, 1, 2, something like that, right? Concerns may also arise about its capital position and that SoFi may need to raise a significant amount of capital to shore up its balance sheet and capital ratios. The counter argument, before we get into the counter argument, first off, and I think this is important before we get into the counter argument, okay? At the end of the day, SoFi is a bank. Now, the reason, it's such a simple thing to say, but the reason it's so important is you have to understand these companies are extraordinarily scrutinized, and they have certain rules and regulations they have to follow, okay? Especially when it comes to assets to liabilities ratios and a lot of other things, right? And so what you got to understand is, you know, an article like this can make it sound like SoFi is just doing whatever, right? You know, if you're not super well versed on what all these things mean, you might hear this and you might think, wow, SoFi is just a wild, wild west and they're just getting to do whatever they want. It doesn't work like that. If you're a bank, if you're a financial institution, you can't just do whatever the heck you want, right? There's a few little switches and changes you can make here, but at the end of the day, the Federal Reserve looks at a lot of this sort of stuff that's going on, right? When we're talking about everybody overlooking the entire banking system, these regulators are consistently looking at all these companies, right? It doesn't mean they can't go under, because we see banks fail, right? But you just got to understand this is a heavily scrutinized space. And so to try to make it sound like the Wild West is just not a reality, just to be quite frank, okay? And so I think I just need to say that first and foremost. Now, the counter argument from the bulls would be that SoFi borrowers have high FICO scores on average in the 740s, and that it has plenty of buffers with the current CET1 ratio of 17%. While the above counter arguments have some validity, I submit the following. 1, in such a scenario, SoFi stock may sell off hard due to uncertainties with respect to fair market value and or the level of reserves needed. Mr. Market tends to shoot first, ask questions later, and thus SoFi management may be forced to act by the markets and or regulators. That's true. I can't push out back against that. If the market got incredibly freaked out and it wanted to sell these stocks off and it sold off at SoFi, to $3 or something like that, I can't argue against that. That's always a potential. That's always a possibility, right? Like what are you going to say to that? I can't. There's no debating that. Like that's possible, right? But I could say that for a lot of stocks in the market, right? And if they could crash 50+% if the market, got into some situation where it was just sell everything by any means necessary, right? Number 2, the report of 17% CET1 is somewhat inflated by the above-mentioned accounting treatment. Professional investors would adjust that figure for CECL and fair market value to reflect a much lower adjusted number. Back of the envelope calculation assuming 6% CECL and reversing $607 million of fair market value gain yields, CET1 of 9%, and thus arguably too low for such a highly concentrated bet on unsecured personal lending. Final thoughts. For some professional investors, shorting SoFi is almost a perfect macro hedge on a consumer recession. SoFi is expensive by traditional metrics, tangible book value, utilized by most banking investors. But to push back against that, remember, SoFi is very high growth financial institution that is really kind of leading the way with the newer generation. And so, take that for what it is. So overall, I don't think they have bad opinion there. I appreciate that gentleman's opinions in kind of what he brings out there. With that being said, would a lot of bank stocks crash in some sort of major recession with higher unemployment? Sure. That's what happens. That's what happens in a recession. Go back to the great financial crisis. There was financial institutions, down all over the place, going under completely, right? And then there was a ton of others that were getting hit 40, 50, 60, 70%. So that's just a risk you have to be willing to take. To be quite frank, it's a risk you have to be willing to take in the market in general, and certainly in regards to these sorts of stocks. And so that's why SoFi for me, right, is a very, very small position. I'm looking to add more SoFi shares over likely this next few months, but it has to be a small position for me. SoFi can't be a massive position. No financial can. If you told me I had to make a massive position in a financial institution, I would go JP Morgan. But there's not going to be a ton of upside growth there for JP Morgan at this point in time. So that's not very attractive to me, right? SoFi is attractive because you get that potential, 2x, 3x, 10x over the coming years, as long as they make it through the storms and those sorts of things. And it sounds like Anthony Noto's plan is safer than not. And so I don't know, and I'll push back once again on the notion of SoFi being this Wild West, because there's a lot of things Anthony Noto and the management team could be doing right now to really push the business, if they really wanted to, in a very risky direction, and they're not doing that. So, but at the end of the day, financial institutions come and they go. And so could SoFi go under in some dramatic situation? Sure. And that's why it's got to be a smaller position for me, right? But honestly, a lot of the differences between a SoFi and, let's say, a Wells Fargo or Bank of America or JP Morgan Chase is the government wouldn't let those big dogs fail. They would let SoFi fail. So that's the other important thing to remember. Those other big financial institutions are really, unfortunately, too big to fail, so they can't let them fail. But a SoFi, if they really wanted to let that fail, they would let that fail. They would have no problem with that, right? So I think it would be bad for the banking system overall for the long term, because I think you need innovators like SoFi to stay in the space. But anyways, that's kind of, that's that situation. And once again, I think the bet for a lot of these folks isn't really about SoFi going under. It's more like SoFi goes to $3 or $4. I think that's more the play there, right?